Welcome. In this video we are going to talk about decision making and relevancy. Now remember, we earlier identified in this course that there are 5 fundamental information needs for managers. The first is to capture resource consumption. That's the various different costing issues that we've been looking at so far in this course. The second is to provide information for process improvement. That is looking at how we actually engage in work, the activities we do, so forth and so on, and determining whether those activities are efficient and effective. That's resource management, which is also cost management. The third objective is to provide information for tactical decision making. That's the type of problems that we'll be looking at here shortly. The fourth objective is to provide information for performance evaluation, and the fifth objective is to provide information for the preparation of financial statements, specifically the valuation of cost of goods sold and inventory. Now, this third objective, to provide information for tactical decision making, is the issue that I personally find to be the most interesting within the area of the broad field of managerial accounting. However, this can be challenging to students for the following simple reason. There is almost an infinite list of tactical decisions which we could find ourselves confronted with. So there's no way to really go through and look at all of them. That being the case, the objective becomes how to systematically and methodologically approach problems. How do we set these things up irrespective of what type of problem it is? So in any decision-making scenario, the first step is to clearly understand what decision we have at hand. That means identifying what are our alternatives. In order to have a decision, I must be in a situation where I'm making a choice between doing option number 1 versus option number 2 versus option number 3, or whether I'm confronted with a choice between doing something and not doing something. So the first step is to identify our alternatives. If we were going to lay this out in a systematic way, these would be the various different columns we would have. The second step is to determine what is relevant to those decisions. Now realize that we can have relevant quantitative and qualitative factors that are relevant. What we're focusing on right now is a quantitative analysis of these type of problems. In other words, we're focusing first on the quantitative factors that would affect our decision. Once we've done that type of economic analysis or quantitative analysis, then we can look at qualitative factors. For example, we can economically determine that maybe we should not do something. We should not make a particular decision, but nonetheless we decide to go ahead and do it for strategic reasons or for other non-quantitative reasons. That's perfectly fine, but that would be an example of an informed decision. It's an uninformed decision if we simply do something for, say, a strategic reason without having done the quantitative analysis first. So let's make sure we always do the quantitative analysis. Okay, that said, what are the quantitative factors? Well, all decision making is based on a cash flow analysis. In other words, cash coming in, cash going out, subject to our different alternatives. So basically what we're going to do is we're going to create a little mini income statement for each one of our alternatives to identify cash coming in and cash going out. So we have those 3 items. Cash coming in would be represented by sales, and cash going out would be represented by variable costs and fixed costs, since in a managerial content, that's usually the format in which we're going to receive that information. So we have those 3 relevant items. A fourth possible item is opportunity cost. Now, what is opportunity cost? Opportunity cost exists when we are constrained, and it is the contribution foregone by our next best alternative. So once we've identified our alternatives in our given decision, the next step is to identify whether we have any constraints. Because if we do have constraints, then we may possibly have an opportunity cost. If we do not have constraints, we will not have an opportunity cost. Okay, there are 3 types of constraints: input constraints, output constraints, and managerial constraints. Input constraints are physical constraints. For example, we have X amount of production capacity. We have Y amount of raw material available. Those would be examples of input constraints. Output constraints are demand constraints. We can only sell X amount of our product. And then managerial constraints are discretionary. They're the result of a managerial decision. Okay, While there's a wide multitude of different types of decision-making scenarios we can be confronted with, I always like to start off a discussion about this topic with a particular type of decision-making scenario, and that's what we refer to as a scarce resource or a product emphasis scenario. The reason for this is, out of this, we're going to develop a tool which we can apply in those situations where it's appropriate. This is quite similar to what I said previously when we were talking about cost, volume, profit analysis, and suggested you get into the habit of recognizing whenever you have a sales price, a variable cost, and a fixed cost, with those three pieces of data, you can calculate a whole bunch of different information. Your contribution margin per unit, your contribution margin ratio, your break-even in units, your break-even in sales, and then with a fourth data point, an actual observation or expected observation level of volume, you could calculate margins of safety and operating leverage. Okay, so let's take a look at a problem here which deals with a product emphasis scenario. You've got a takeout store on a popular beach resort. The owner's trying to decide how much refrigerator space to devote to 4 different products. And then we're given information, sales price, variable cost, and the number of cases we can sell per square foot of the shelf space. The next paragraph, we're told that we have a maximum of 12 feet of shelf space, and then the manager also wants a minimum of 1 foot and a maximum of 6 foot for any given drink. And then we have various things that we're asked to do. Okay, step number 1 would be to determine what are our alternatives. Our alternatives is to take the 12 feet of shelf space and dedicate it to one of 4 different products: cola, lemonade, punch, or natural orange juice. Step number 2 is to identify any constraints we might have. Do we have any input constraints? Yes, we do. We have 12 feet of shelf space. Do we have any output constraints? No, we don't. Do we have any managerial constraints? Yes, we do. The manager wants us to have at least 1 foot dedicated to each product and no more than 6 feet dedicated to each product. Okay, step 3, identify what is relevant to each one of these alternatives. And what's relevant is going to be cash coming in and cash going out. Now, we have not defined relevancy, so let's do that now. In order for something to be relevant, 2 conditions must exist. It must change between our alternatives, and it must exist in the future. Therefore, by definition, anything that's happened in the past is irrelevant. So here's a little example to illustrate this point. Suppose that you're considering buying a house, and the house costs $100,000. All right, from a decision-making standpoint, you would set this up as a problem where you have option 1, buy the house, option 2, do not buy the house. Is the purchase price of the house $100,000 relevant to the decision of buying the house? Yes, it is. Why? Because it changes between the 2 different alternatives. Okay, now you're going to sell that house, assuming you've already bought it. You're going to sell that house. Was the purchase price you paid for the house relevant to the decision of selling the house? Okay, so what are our alternatives here? Sell it or don't sell it. Is the purchase price relevant? No, it's not. Why? Because whether I sell the house or whether I don't sell the house, the purchase price, what I paid for the house, is not going to change. Therefore, it is irrelevant. Now, if you think about it, I'm sure you're aware of situations where you've known people that are engaged in a similar type of situation where they're trying to sell their house, but yet they're focused on what they paid for their house. Well, that's an example of erroneous decision-making. Decision-making itself is very straightforward. The 2 major problems with decision-making relate to relevant information. In other words, including something that is irrelevant, as we just did in the example I gave with the purchase price of the house, or leaving something out of the problem that is relevant. Okay, so we've identified that we have 4 different alternatives here. If we were just going to look at the sales price of each one of these products and trying to decide what to do in terms of how to allocate these 12 square feet, and for the moment, let's ignore this managerial constraint. So right now, we'll simplify the problem and assume that all we're trying to do is figure out how to allocate the 12 different feet between the 4 different products. If we were to only look at the sales price, what would be the problem with that? Well, the problem would be we would be leaving out relevant information. For example, the variable cost of each one of these products is relevant. Likewise, the demand that each one of these products makes upon our scarce resource is relevant. Okay, so if we've determined that the sales price and the variable cost are both relevant, we can summarize those by calculating the contribution margin for each one of our products. And if we were to look at the contribution margin for each one of these products and make some decision based upon that, again, that would possibly be lead to erroneous decision making because, again, we might be leaving out some relevant information. Specifically, this information right here, the fact that each one of these products makes different demands on our given resource here. In other words, if I dedicate one foot of shelf space to cola, I am going to be able to sell 5 cases, whereas if I dedicate that same foot of shelf space to lemonade, I can sell twice as much, 5 times as much, and a little bit more than twice as much. Okay, this is all relevant, so we need to include that. So here's where we're going to introduce a concept, and any time we can identify where this concept is pertinent, then it's very useful in the same way that the cost, value, and profit stuff that we looked at in the previous chapter can be very useful. And that concept is contribution margin per constrained resource. Okay, our contribution margin per constrained resource in this case being shelf space per day, for cola is $24.50. In other words, each case of cola has a contribution margin of $4.90. 1 foot of shelf space, we can sell 5 cases. Therefore, the contribution of that 1 foot of cola would be $24.50. Likewise with lemonade. Each case of lemonade has a contribution margin of $4.15. However, 1 square foot, we can sell 10 cases. Therefore, the contribution from that 1 square foot is going to be $41.50. Likewise, we can do the same thing for punch, and we can do the same thing for orange juice. So notice here we have our contribution margins. These are contribution margins per unit of output. These are contribution margins per unit of input. Okay, now how would we go about determining how to allocate those 12 square feet? If we take all 12 feet of shelf space and apply it to cola, that will generate a total contribution of $294. In other words, each foot will generate a contribution of $24.50 because each square foot of cola will be able to sell 5 cases, and each case has a contribution margin of $4.90. So in this row right here, we can determine the total amount of contribution we would be able to generate from each of our different options if we took all 12 feet and applied that resource only to each one of these products. All right. The fact that we are constrained means we may have a opportunity cost. I say may because we can have constraints, but we may not necessarily be constrained by those constraints. But in this case, we are. So we're constrained by the fact that we only have 12 feet. So if I take all 12 feet and dedicate that to cola, then I'm going to have an opportunity cost. Now, how do I measure what that opportunity cost is? It is the contribution foregone by my next best alternative. Well, if I dedicate 12 feet to cola, I cannot dedicate it to something else, and the best other alternative would have been punch. So the opportunity cost of dedicating all 12 feet to cola is $1,800, and my net economic effect is a negative $1,506. Likewise for lemonade, if I dedicate all 12 feet to lemonade, that would generate total contribution of $498. However, if I do that, I can't do my next best alternative, which again is punch. So I have the same opportunity cost of $1,800, and there's my net economic effect for lemonade. If I dedicate all 12 feet to punch, I'll generate a contribution of $1,800, but there will be an opportunity cost because I can't do my next best alternative. Well, what is my next best alternative to punch? It would be orange juice. So there's my opportunity cost, and there's the net economic effect of punch. And then finally for orange juice, if I dedicate all 12 feet to orange juice, I'll have a total contribution of $1,331.20, However, my opportunity cost is my next best alternative, which would have been to use all 12 feet for punch, and there is my net economic effect. So I can see that what I should do here is dedicate all 12 feet to punch. Now I can work my way through that long analysis, or I can simply come up here and look at my contribution margin per unit of scarce resource and see that the resource, given the demands that each one of my products makes on that scarce resource, 1 unit of that resource dedicated to punch would generate the highest contribution margin. So the product that I want to emphasize would be first punch. I would want to dedicate as many feet to punch as I could. Then if I couldn't dedicate any more space to punch, I would then go to my next best alternative, which would be orange juice. And then once I had exhausted all my possibilities for orange juice, I would go to my next best alternative, which would be lemonade. And then finally, if I still had any resource left over and I couldn't dedicate it to lemonade, I would dedicate it to cola. So that's how we would prioritize our different products using this concept. This concept right here is the concept that's being introduced right now. Contribution margin per unit of input. Input specifically being our scarce resource. Now there's a whole bunch of things we can do with this information right here. Extremely useful. These are what are called shadow prices in linear programming. So what happens if I take 1 unit, 1 square foot in this case, away from punch and were to give it to cola? Well, I would be giving up $150 of contribution, and I would be receiving $24.50 of contribution. What would happen if I had to give up 1 unit of lemonade and I was going to replace it with punch? Well, I would be giving up $41.50 of contribution, and I would be receiving $150 worth of contribution. Okay, now let's look and see how we would actually go about allocating those 12 feet of shelf space. And we will also include the managerial constraints, the idea that the manager wants us to have at least 1 foot dedicated to each product. In other words, we want to have all of our 4 products available and no more than 6 feet dedicated to any given product. So a couple different ways we could set this up. Remember, this is a small problem, so we could do it in an ad hoc fashion, but I really would encourage you to be very systematic about it. So here's how we're going to go about doing this. I've got 12 feet of space to allocate. I'm going to go to this constraint first, and I'm going to allocate 1 foot to each one of my products to satisfy that constraint. As I do that, what's going to happen? My 12 feet, I'm going to end up using 4 of my 12 feet. I'm going to have 8 feet remaining. Okay, with those remaining 8 feet, what can I do? Go to my second constraint there, maximum of 6 foot per product. Well, I know that my most desirable product is punch, so I would like to allocate as much of that remaining 8 square feet to punch as I can. However, I cannot allocate any more than 6 feet to any given product. I've already allocated 1 foot, so I will allocate an additional 5 feet to punch. That leaves me with 3 feet. I go to my next best alternative, which is orange juice, and I allocate the full 3 units to orange juice. And that allows me to determine that I would end up with 6 feet allocated to punch, 4 feet to orange juice, and 1 foot to both lemonade and cola. Okay, with that allocation of those 12 square feet, subject to the 3 constraints, the input constraints and the 2 managerial constraints, as you can see here, we would generate a total contribution of $1,376.40. Now, it's important to recognize whenever we have managerial constraints as opposed to input constraints and output constraints, managerial constraints are discretionary. In other words, in this problem, the owner simply decided that she wanted to have at least 1 square foot for each product and no more than 6 feet for any given product. And the point here being that constraints constrain our optimal output, and therefore they have a cost, and we can go and we can calculate what that cost is. In other words, let's eliminate those constraints and determine what we would do. Well, if we didn't have those 2 discretionary constraints, we would take all 12 feet and give that to punch, in which case we would generate a contribution of $1,800. So we can determine that the cost of the managerial constraint was $423.60. So identifying this cost of the managerial constraint doesn't mean that those constraints shouldn't be there. What it means is that we were able to quantify the cost to this business of those managerial constraints. That's very, very important because anytime we engage in actions that constrain our activities, rules, regulations, so forth and so on, there is a cost associated with that. The problem is the cost is generally not recognized and therefore ignored. Okay, now let's take a look at a problem that deals with a special order. Here we have a packing company that manufactures 1-liter plastic bottles. They've got a molding machine that's capable of producing 100 bottles per hour. They estimate the variable cost of producing a plastic bottle. They give us the sales price for the bottles. And then management's been approached by a local toy company that would like the firm to produce a toy for them. And then we're given information about the toy, what the sales price would be, what the variable cost would be. In addition, there would be a fixed cost of $20,000 to construct a special mold. We're also given information on how our existing molding machine, what its capacity of production would be for both bottles and toys. We're told what the quantity of the special order is, 100,000 units, and we're told what the total manufacturing capacity available is. We're also told that the firm has fixed cost, excluding the cost to construct the toy mold, of $200,000. Okay, and then we have a bunch of different requirements there, and we'll get to that in a moment. So my first step is I want to extract the data from the problem and organize it in such a way that is conducive to creating as much information as possible about the problem. Because once again, what I want to do is just figure out what's going on, and then I can go and answer any type of question. Okay, so what's the various different alternatives we'll have? We actually have two different decision-making scenarios here. In one case, we have a decision-making scenario where we have to accept the toy order in full, all 100,000 units. And in another decision-making scenario, we can accept any quantity of the special toy order. So we'll get to those two different decision-making scenarios here in a moment. Our next step would be to identify what constraints we have. Okay, do we have any input constraints? Yes, we have a limited amount of machine hours on our molding tool. We have 10,000 machine hours available. Do we have any output constraints? No. Do we have any managerial constraints? No. All right. The next step would be to construct as much information as possible from the data that we have. So drawing on stuff that we looked at previously, the cost, volume, profit stuff, we can see here that we are given a sales price, a variable cost for our bottles, so we can calculate our contribution margin per bottle. We can calculate our contribution margin ratio. We could, if we wanted, calculate a break-even point for bottles. And what we just looked at in the previous problem, the one on product emphasis, we can calculate our contribution margin per constrained resource. So each bottle that we manufacture will give us a contribution margin of $30. However, we can make 100 bottles per hour, so that gives us a contribution margin per machine hour of $30. Over here is the information on the special toy. Sales price $3, variable cost $2.40, contribution margin per toy per unit of output of 60 cents, our contribution margin ratio, the number of units required in the special order. In other words, we can possibly produce less of these, but no more than these. So in a sense, that's a constraint on the demand for the special toy. The productivity of the toy on our machine can only produce 40 toys per hour. So we can calculate our contribution margin for toys per hour, which is $24. Now, before we go any further, if we had not calculated these two amounts right here, we might have had the impression that it was a whole lot more profitable to make toys than it is to make bottles, in which case you have to ask the logical question, why aren't we in the toy business instead of being in the bottle business? But as we can see here, it's actually more profitable to make bottles than it is to make toys. In other words, 1 unit of input dedicated to the manufacture of bottles produces a contribution margin of $30, and 1 unit of input, 1 machine hour dedicated to the production of toys only contributes $24. Also, we have a fixed cost incurred if we make toys. In other words, if we make just one toy, we're going to trigger that fixed cost. Okay? What else can we calculate in terms of creating information? Well, as I said before, you should get in the habit of recognizing anytime I have a sales price, variable cost, and fixed cost, that little bell should go off and say, oh yeah, break-even stuff. Okay, so I can calculate my break-even unit in toys. In other words, how many toys do I need to be able to make in order to break even? Well, that'd be 33,333.33 toys. What would be the total sales, break-even in sales for toys? That would be 100,000. We could also determine, since we know how many units it takes to break even in toys, we could also calculate how many machine hours need to be available in order to break even in toys. And that would be 833.33 machine hours. How did I get that? I took the number of toys I need to break even and divided it by the fact that each machine hour will produce 40 toys. So I took that number and divided by 40. Okay, so even though it didn't ask us for any of this break-even stuff, we've already learned it. It's applicable to the problem. It provides more information that makes it easier to understand what's going on and analyze any given scenario that we might be confronted with. All right. If we look at the questions over here, we have two different types of scenarios. One, we have a scenario where we have a certain amount of demand for the bottles and the toy order has to be taken in full. That's question 1, 2, 4. Okay, questions 1, 2, and 4. Questions 3, 5, and 6 give us some level of demand and say any quantity of the toy order can be taken. All right, so we're going to deal with this first scenario here first. So let's build a little model here. Currently, the demand for the bottles is 750 bottles. In order to meet that demand, that will consume 7,500 machine hours. That will leave us with excess capacity of 2,500 machine hours. Since we have to accept the toy order in full, that's 100,000 toys. In order to make those 100,000 toys, given that it takes 40, that we can make 40 toys per hour, we will need 2,500 hours, which we have available, excess capacity. So we can come down here, and basically our decision is accept or reject. So obviously if we reject, the net effect's going to be 0, so we don't have to lay that out. So what we will do here is calculate the economic effect of accepting the special order, given that the demand for bottles is 750,000 units. All right, so we'll make 100,000 toys. We will use 2,500 hours to do so. We have 2,500 hours available. The total contribution from doing so will be $60,000. We have a fixed cost of $20,000. That gives us a net income of $40,000 on the special order. We have 0 opportunity cost. Why? Because we do not have to give up making any bottles in order to make our 100,000 toys. So the net economic effect, given that level of demand, will be $40,000. Okay, what happens when demand goes up to $850,000? Well, if demand goes up to $850,000, more machine hours will be consumed, less machine hours will be left over, so now we only have excess capacity of 1,500 machine hours. We still have to make 100,000 toys. That's going to require 2,500 hours. So all of this information right here is not going to change through any of these scenarios because we're going to make all 100,000 of these toys. But what you should start to notice, what happens is the variable that starts to change as the demand for bottles changes is my opportunity cost. In this case, I have an opportunity cost. Why? Because I am 1,000 hours short of machine hours necessary to make the 100,000 toys. In order to make the 100,000 toys, I have to take 1,000 hours away from bottles. Each bottle or each hour dedicated to bottles contributes $30. So 1,000 hours taken away from bottles at a contribution margin per machine hour of $30 gives me an opportunity cost of $30,000. So the net economic effect is $10,000. So I would still accept the special order. However, it's much less profitable than it was before because I've incurred a significant opportunity cost. Now what happens when the demand goes up to 900,000 units? As the demand goes up, consumption of machine hours for bottles goes up, excess capacity goes down. As excess capacity goes down, what happens? My opportunity goes up. In this case, I'm 1,500 hours short of what I need in order to make the 100,000 toys. I've got to take 1,500 machine hours away from bottles. Each hour contributes $30, so I now incur an opportunity cost of $45,000, and the net economic effect is no longer positive. It's now a negative $5,000. Now, what you should have noticed from our previous discussion about cost volume profit analysis, another concept that was introduced at that time was the idea of an indifference point. So what we could do is we could calculate that level of demand at which we would be indifferent to accepting the special order. How would we go about doing that? Well, the point at which I would be indifferent is the point at which the net economic effect of the special order would be zero. The net economic effect of the special order, in order for it to be zero, the opportunity cost would have to be $40,000. So if my opportunity cost is $40,000, and if each bottle contributes 30 cents, then how many bottles would I have to not produce in order to incur an opportunity cost of $40,000? That would be 133,333.33 bottles. In other words, if I don't make those bottles, even if I have demand for them, that would give me an opportunity cost of $40,000. Okay, so what would be my indifference point? Well, if you remember, when the demand for bottles was 750,000 bottles, we had just enough excess capacity to meet the needs for manufacturing the 100,000 toys. So basically, the way to understand this is if demand goes up above 750,000 bottles, what's going to happen is I'm going to start to incur an opportunity cost. If the demand went up to 750,001 bottle, what would be my opportunity cost? Well, it would be the cost of that bottle, or 30 cents. If demand went up to 750,002, well, there'd be 2 units I couldn't make, and so my opportunity cost would be 60 cents. Well, if it's 133,333.33 bottles I can't make, then what is the level of demand at which I would be indifferent to accepting the special order? It'd be 883,333.33. 883,333.3 will consume 8,833 machine hours to meet that demand. That will leave us with an excess of 1,167 hours available to make toys. To achieve the 2,500 hours that we're going to need, we're going to have to take away the difference between the two of these from the manufacturer of bottles, and then that amount times the contribution margin per hour of $30 will give us an opportunity cost of $40,000. So in summary, in this case where we have to accept the special order in full, we may have an opportunity cost. As the demand for our regular product, our bottles, goes up, the opportunity cost of accepting the special order goes up. Why? Because in order to manufacture the 100,000 units, we have to take constrained capacity away from the manufacturer of bottles, and that creates an opportunity cost. This is going to contrast with the other scenario where we can manufacture any amount of the special toy order. So in this situation where we have the flexibility to accept any quantity of the toy order, we've got a different kind of scenario here. First off, we can see up here that anytime we're given a choice between making bottles and toys, what are we going to do? We're going to make bottles. So we're going to fully satisfy that demand for bottles, which is going to consume 8,500 hours. That's going to leave us with 1,500 hours of excess capacity available to make however many toys we can. Well, with 1,500 hours, we can make 60,000 toys. If we can only make 60,000 toys, our contribution will be $36,000. Our fixed costs do not change, and our net income would be $16,000. $16,000. So we would go ahead and take that excess capacity and use it towards the manufacture of toys. Now assume that the demand for bottles goes up to 900,000. That leaves us with less excess capacity of only 1,000 hours available to make toys. We would only be able to make 40,000 toys. That would give us a contribution of 24,000, fixed cost of 20, and we're still going to have a positive net income, so we would do it. What would happen if demand for bottles goes up to 950,000? Well, if demand for bottles goes up to 950,000, we're only going to have 500 hours available to make toys. We're only going to be able to make 20,000 toys. That's only going to contribute $12,000, so we're going to actually have a net loss of $8,000. Now, we didn't even need to do this. Why? Because we'd already determined what our break-even point was for toys before we even started. We knew that it would not be worth our while to manufacture toys unless we were able to make 33,333.33 toys. Here we're only able to make 20,000 toys. Furthermore, before we even started, we figured out how many hours would be necessary in order to break even to make toys. That was 833 hours. So we don't even have to go past this point right here, because when we see that our excess capacity is below the number of machine hours necessary to break even on the special order, we can stop right here and determine that we don't need to go any further. So now let's take a look at the last question here in this situation where we have the option of subcontracting out the toy. That's the information over here. If we subcontract out the toy, we'll still be able to sell it for $3. That hasn't changed. However, our cost of acquiring the toy, our variable cost, will increase from $2.40 to $2.80. So the contribution margin on any toy that we subcontract out will be 20 cents as opposed to 60 cents. However, there will be no cost associated, fixed cost associated with subcontracting out. All right, so in this situation, this is a continuation of the second model that we were working with, where we have the flexibility to accept any order of the toys. So we have demand for our bottles of 900,000 units. That's going to consume 9,000 hours. That's going to leave us with 1,000 hours left over. Those 1,000 hours, if we dedicate them to the manufacture of toys, will allow us to produce 40,000 toys, which will leave us with a net income of $4,000. All right, so now we have two different options. We can go ahead and take that excess capacity, manufacture 40,000 toys, earn a net income of $4,000. That's summarized right here. And then subcontract out the remaining 60,000 toys, earn a contribution on that of 20 cents per toy, earn a net income on those 60,000 units for a total of $16,000. In other words, that right there would be the total amount of net income we would earn from the option of producing and subcontracting out the toys. If we just subcontract out the toys, we'll take all 100,000. We'll meet the demand for the toys of $100,000 by subcontracting it out. That's 100,000. Each toy has a contribution margin of 20 cents, and that will generate a net income of $20,000. So what should we do here? We should not utilize this excess capacity and go ahead and subcontract out the full 100,000 units. So that's counterintuitive. We would, without actually crunching the numbers, we'd be inclined to think that, hey, we got excess capacity, we've already paid for it, we might as well utilize it. But in this particular case, it turns out that our best option is to subcontract out the entire special order. All right, that's it.